With money comes power, and with power comes leverage. Nowadays, the wealthiest people in the world most certainly use different tax haven countries, and we'll be checking out the top 10 tax haven countries, how the system works, and why the rich use these countries in particular to benefit them in the long run. Make sure to stick around till the end for the full details. What is a tax haven, you may ask? Any place with extremely lax or even non-existent tax rules is considered a tax haven. Around the world, there are many tax havens, including Switzerland, Bermuda, Dominica, and the British Virgin Islands. Every place has different local tax regulations. Others have essentially no taxes, while some just tax income at lower rates, sometimes as low as 2%. For instance, the British Virgin Islands have a 0% effective income tax rate, no corporation, estate, inheritance, gift, or sales taxes. Number 1. Bermuda. Bermuda is a stunning island with no income tax and a 0% tax rate, making it ideal for investors and those looking for an offshore location. Bermuda places one of the best emphases in the world on bankers' privacy. Charity Oxfam has described Bermuda as the world's worst tax haven. By worst, they mean they have allowed companies to save the most on their taxes, which could equal the best when looked in the perspective of the corporation, but worst for good of the world. U.S. companies reported $80 billion worth of profit in Bermuda in 2012, which is more than their combined profits in China, Germany, Japan, and France in that calendar year. This is bad for other countries who may have benefited from the potential tax revenue on those corporate profits, if those companies were based there. Number 2. British Virgin Islands. Another British overseas territory that acts as a tax haven is the British Virgin Islands, which has no corporate income tax and no capital gains tax, but does have a payroll tax of 10 or 14% depending on the size of the business, with 8% of that amount being paid by the employee and the remainder by the employer. The Panama Papers revealed an example of this secrecy in which Ukrainian President Poroshenko, who had agreed to close his company if elected, Bernie simply moved it to the British Virgin Islands instead. The British Virgin Islands allow companies to base themselves there secretly without any public record of who owns them. More than half of the companies uncovered by the Panama Papers leak were registered in the British Virgin Islands, or BVI. The authorities in the British Virgin Islands, according to Duncan Haynes, Director of Policy at Transparency International. This secrecy allows corrupt individuals who steal public funds to hide them around the world. Although it is lawful to possess and transfer funds through BVI corporations, the most infamous scandals in the world frequently involve shell firms founded on the island. A $2 billion plot involving BVI companies and a close ally of Russian President Vladimir Putin led to the jailing of Israeli entrepreneur Benny Steinmetz as part of a corruption deal. Number 3. Cayman Islands. The Cayman Islands are arguably the most effective tax haven in the world and are a favorite choice for both businesses and financiers. There are no corporate taxes in this country, which is a wonderful windfall that firms take advantage of to avoid paying heavy and higher taxes. The Cayman Islands have zero direct taxes on citizens in addition to having no corporate tax. They do not pay any payroll taxes, capital gains taxes, property taxes, income taxes, or withholding taxes. Therefore, they are viewed as tax neutral. The Cayman Islands generate income through fees associated with stay-over tourism and work permits, financial activities, and import levies rather than through direct taxation. Most items imported into the Cayman Islands are subject to duty charges, which range from 22 to 27%. Baby formula is the one product that's exempt from duty taxes, although other products, like cars, are taxed at a higher rate based on the vehicle's value. The duty tax rate for pricey automobiles might reach 42%. Number 4. Switzerland. The Swiss are perhaps most well known for their successful and reliable financial institutions, which they have maintained their neutrality in times of crisis, in addition to producing delectable chocolate. The nation is well known for consistently being dependable when it comes to offshore tax havens. Both wealthy Europeans and clients from other countries enjoy it. Both Swiss citizens and immigrants are required to pay taxes, but the rates are lower than in many other nations. For income and corporation taxes, the federal government establishes a basic amount. Following these thresholds, the Swiss cantons establish their own rates. This approach has historically led to competition among cantons to provide the best prices for foreigners wanting to store assets. This indicates that rates vary widely throughout Switzerland and that some regions function more like tax havens than others. Number 5. Monaco. It's relatively simple for people to live in Monaco and work in France or other European countries because of the tiny principality's area of just 499 acres, or 0.7 miles. The fact that it hasn't imposed an income tax on its residents since 1870, and the fact that it doesn't levy a capital gains tax or a dividend tax. You simply just need to live there for 6 months and a day per year to be eligible to the given terms. Monaco has 38,000 residents in total. They are currently working on a project to reclaim land from the sea that will increase the size of the territory by 15 acres and provide land for new luxury apartments and a 30-ship harbor with tax rates as high as 60% in countries like Sweden because they have so many millionaires that they are running out of space to put them. I completely understand why wealthy Europeans would want to relocate. Number 6. Jersey. Next on our list is a tax haven, Jersey. Instead of the U.S. state New Jersey, which is closer to France than it is to the UK, we are referring to the British Crown dependency of Jersey, whose citizens pay income tax at a maximum rate of 20%, which is less than half of the top rate in the UK. When affluent Brits started relocating to Jersey, or in many cases simply transferring their fortune to the island in the 1920s, to take advantage of its absence of wealth and inheritance taxes, the island first developed a reputation as a tax haven. Mainland Jersey also levies VAT, a kind of sales tax at a far lower rate than the UK or France, which has caused a fulfillment industry to ship small goods like DVDs and lingerie to the UK and other EU nations at a lower price than the local competition. Additionally, Jersey levies a 10% company tax rate and doesn't impose any corporate taxes on the majority of businesses. The Jersey government enacted a 2.5% income tax in 1928. The income tax was increased to 20% during the German occupation of the Channel Islands, where it is currently. However, the island has remained free of any inheritance, wealth, corporate, or capital gains taxes. Number 7. The Bahamas. With no taxes of any kind, the Bahamas in the Caribbean is every corporation's ideal location. It's a true blessing for illustrious businesses. Their banks are the epitome of secrecy. They have had a bad reputation for providing information without being transparent or private. With a per capita GDP of $28,239 as of 2021, the Bahamas is also one of the richest nations in the New World. English is their official language. The US, Canada, Switzerland, the UK, Brazil, and Japan are represented by financial institutions operating in the Bahamas. Nassau is home to several significant international accounting firms such as Deloitte & Touche, KPMG International Cooperative, and PricewaterhouseCoopers International Limited. There are no limitations on foreign investors purchasing property in the Bahamas. All real estate transactions are subject to a graded stamp tax imposed by the government. The stamp tax ranges from 2.5% to 10%. Investment properties are subject to property tax based on assessed value. The tax rate is 1% for investment properties worth less than $500,000 in Bahamian currency. For homes worth more than $500,000, the tax rate is 2%. Owner-occupied properties have a maximum annual property tax of $60,000. Number 8. Singapore. Now let's look at Singapore, the only Asian territory on this list and one of the few remaining sovereign city-states in the globe. In this prosperous Southeast Asian nation, business taxes are seen as low-level. Singapore is a highly booming economic center with an estimated GDP of more than $1 trillion. Singapore permits investors and businesses to pay reduced taxes since it serves as the center of commerce, business, and the regional economy. The maximum personal income tax rate in the nation is 22%, but that rate only applies to wealthy incomes. Singapore's progressive tax structure has starting rates as low as 2%. The nation offers numerous tax-free benefits for startups and other types of businesses, despite charging a corporate tax rate of 17% for income over $2 million. Singapore is therefore regarded as a top business destination. Number 9. Mauritius. It's not surprising that Mauritius, an island nation in the Indian Ocean, has developed into a tax haven due to its extreme isolation. The majority of Indian corporations are the main users of this tax dodge. While there is a corporate tax in Mauritius, businesses with headquarters in the US and Europe can benefit from the unique applicable tax rules. The offshore jurisdiction of Mauritius, which is proactive in its goal of becoming a hub for wealth management for sub-Saharan Africa, and the Indian Ocean region, is comparable to Liechtenstein, Jersey, Panama, and other favorable offshore jurisdictions as a site to conduct business. With a per capita GDP of $15,400, one of the highest in Africa, and a growth rate for the year of 3.3%, Mauritius' GDP was estimated to be $19.98 billion in 2012. Over the past 10 years, Mauritius' economy has expanded gradually. Compared to its GNP, the nation has the 18th highest gross national savings in the world. Number 10. Luxembourg. Then finally coming in at number 10, we have Luxembourg. Apart from the fact that it's currently one of the richest nations in the world, Luxembourg has long been regarded as a popular tax haven. Despite the EU's most recent attempts to damage the country's reputation as a tax haven, it remains a financial powerhouse. Despite having a population of only over 630,000, Luxembourg draws comparable amounts of FDI as the U.S. FDI totaling $4 trillion equates to $6.6 million per person. These inflows and outflows are referred to by the International Monetary Fund as phantom investment. To reduce the taxes owed by organizations that own the empty business shells, a large portion of the money flows into them. According to economists, Luxembourg, Ireland, and the Netherlands serve as tax havens for 80% of the profits that are transferred from EU nations. In 2015, Luxembourg was responsible for $47 billion in shifting earnings. In the same year, Ireland contributed $106 billion, while the Netherlands contributed $57 billion. Okay, people, that's our list of some of the best or worst tax havens in the world, depending on your perspective. Please comment below, subscribe if you're new, and we'll see you next time.